Hey folks, and welcome to the Pipnotic Symposium on this beautiful Friday, the 10th of September 2021. Today we're going to talk a little bit about identifying entries, because this is pretty important, but we're also going to spend a bit of time on profits, because this is at least as important as identifying entries. And this is very important, and I think this is probably the most difficult part to get right because of our psychology. I hear a lot of people saying that they take profits early, and this is simply because we want to reduce uncertainty. We want to remove uncertainty and the fear associated with the uncertainty. And so if you're in a trade and you have a little bit of profit, I mean, you can feel that feeling in your stomach, especially if it's a live account. And that forces us to do things that we don't want to do, and which are not very beneficial for our trading. And this is a natural mechanism that is very good and helps us survive, stay alive in nature, especially. And this is if we're, for example, if we're climbing a rock face. Always take something very relevant from Bali. If we're in Bali and we're walking down the path here, and all of a sudden we see three wild dogs approach us and start to circle us. My number one desire in that moment is to get out of that state of danger. Okay, and the beautiful thing about it is that our body informs us that we need to do something about it, and it prepares our body to do something about it. It activates the reptilian part of the brain. It stops digestion, so all the blood in the core of our bodies moves to our limbs and our muscles, and it prepares us to fight or flight. It also gives us maybe a shot of adrenaline to increase the heart rate, get oxygen pumping around the body, and prepare us to take action. Okay, but in trading, there are no dogs that can bite us. There is no danger of falling off a rock face when you're rock climbing. But there is the danger of losing money, and that can provoke similar feelings and emotions and physical states in the body. This is very fascinating, actually, and I studied this state of fear quite extensively several years ago when I was doing a lot of research in the field of human manipulation relative to my work, the computer hacking stuff, and it was very interesting because while I totally understand that it's important that we try to get ourselves out of dangerous situations, there isn't always real danger associated with situations that we are fearful of, like in trading, unless we are trading like cowboys and not not managing our risk properly. A good friend of mine in Denmark, Lucas, he used to always he used to always refer to these trades, when you just want to try something out. He used to call them "Hey dude" trades, because you're kind of like, "Hey dude," you click in, and you see what happens. And that was a very good representation for it, because you're not thinking about your risk, number one. Number two, you're not really focused about your entry. Number three, you're not really focused about your exit. And so there's no concept of risk management when you click into a "Hey dude" trade or dude trade. He called them dude trades. That's right, not "Hey dude." And I think it's important that before you get into a trade that you plan the trade carefully. And you also have to understand that not all trades are going to be profitable. Many of them, probably about half of them, will result in losing trades, and that's okay. You don't have to be right all of the time. So let's just have a look at this trade. Okay, it's not a special trade, it's just an example that I wanted to put on here. So if we look at this trade, I'm just going to mark it off how we would mark it off according to the trades room. So we have, this stops here, goes like that. Here we have our buy side. Okay, and then we're going to put our sell side here. We can see that we were in the right side of the chart. We are actually in probably the lower 10% of the chart, so we have very good odds for for a bounce. And this is also important to remember, that we're not looking to identify reversals. I wish we were. I mean, I wish I could find reversals every time, but we're not. We're just looking to identify manageable trades, manageable positions where price feeds into an area that is of price sensitivity, and we manage the risk and we take a bit of profit out on the way. Okay, you're not looking, I mean, price is not going to come down here and then go north for 1,000 pips. It's not going to happen. While it could, it's probably not going to happen. There's probably a 99% chance it is not going to happen, and that's okay. But we want to take these trades that we know are going to be, that are higher probability, that are planned. So we identify our risk, we accept our risk, we know where we're going to get out if we're wrong, we know where we're going to get out if we're right, and we also have our entry. Okay, and so this is a good example of that. Let's talk about this. So here, I mean, you can't really see the details here, but here price went up, it went down, it went up, and it came down, and this leg here is right here. And when price came down like that, it established a buy zone, and that buy zone, as a matter of fact, marked off here, as we also do in the trades channel, just here. So I know that when price comes here, if price moves beyond this price point here, then we have fresh, we have black space here, as we also talk about. Okay, so price has not been back to this area since it visited this area here and since it left here. Okay, so we have the origin of the move is here. It moved up here, so the origin of this move is here. The origin of this move to here is just here. Okay, and so now we know what we have to do. And so we put in our entry at a nice area of demand. We identify the buy zone, so we know that if price is able to move beyond that price point, then that'll be an attractive price at which to buy for other market speculants. And so we just mark it off. We put in the trade, we leave it alone. And initially, I'll put a 2-to-1. So we have, I'm risking 1 for the possibility of getting 2. Will I get that? I don't know. Maybe not. Maybe I will. But what we do have to be mindful of is that when price moves down to our area, it's going to form areas of supply which are opposing they are not supporting our buy, and these are going to be challenges for us as price begins to move back up. But notice, what we can also notice here, that we have a price inefficiency here, and maybe we'll have another one here, and hopefully we have one from here all the way down into here. And this is a good thing, because what we want price to do is we want price to move inefficiently into our entry, because when price moves down very quickly, so let me see if I can move that. When price moves down very inefficiently, there is a lot of selling here, less, and up here there may be absolutely zero selling. And so it's very natural for price to have to identify or move to price areas in the market where there are going to be offers that will push price lower. And there might not be any from here to here. And this is why you almost always see price move back to the origin, this bit here, this could be supply, of the move before it continues lower. Okay, and what you'll see also in a situation like this is liquidity will dry up. You know, as it goes lower and lower, it gets very, very thin, and then there's maybe nothing. And if you trade like a stock or a commodity that runs through a central exchange, and you're looking at volume information in the form of, for example, a market profile, then you can actually see that there may be very, very little. Or if you're looking at order books, you'll see that there's very, very little liquidity available in this area. But all of a sudden, down here, you'll start to see the orders pick up. Okay, and this is what we want, because you want price to move. You want price to move inefficiently into your entry because this is a crucial point, because it will not require a big buy order to consume all of the illiquid or limited offers that are available in this leg down. And so price, let's say we find one buy limit here that is big but not too big, that relatively small buy order will be enough to consume all of the liquidity available in this inefficient move, potentially back up to the bottom of the origin, which will be down here. So you could get a price move of, well, from here to here. Okay, and this is why you see price move away, price move back. Why? Because we had price inefficiency, virtually no offers there, no liquidity. Price moves into a slightly thicker side of the market, which is enough to move price to the origin of this move and consume all of the liquidity on its way. Okay, so when you see something like this, where price comes down and it leaves, I mean, price was in this area for a very limited amount of time, so not a lot of buying. Price was not there long enough for a lot of buying to take place, which is a good thing, which means that maybe there is business to be done still at that area the next time price comes down to it. And so now we're looking at it, we're looking for something like this to happen here. And this will enable us to experience price feeding into this area where we clearly have demand. So we clearly have pancakes available at this area. Price comes down, it pokes into the area, and then it snaps back and returns to the origin of the inefficient move into that area. That's what we're looking for. Okay, and so the next part would be, well, where do we get out? What are our targets going to be? Well, while we would like every trade to be risking 1 and pulling in 50, it's not going to happen. So what you can do is you can put an initial risk reward. Okay, this one here I have 1, I have my entry, risking 1, and I have the potential of pulling in 2. That's an initial one. And I'm putting that now because I can't really see what price looks like in this. Oh, that's terrible. In this blank price space here, because price will do something. I don't know what it's going to look like, but if it's inefficient, it supports my long in this area here. If it's not inefficient, if it's moving efficiently down into this area like this, it can still work, but price will probably have to identify the presence of liquidity. And this is when you'll see divergence occurring, typically. And divergence is essentially, if I draw that here, how you have price moving pretty efficiently down into an area. But it can also be an inefficient move, but typically it'll be an efficient move. Price will move up, we move deeper, and then what you'll see is your price leave. Okay, and this is showing us that we have a lot of buying from this price point. So price leaves, and then we revisit the origin of this move, which is down here, the origin of this move, which is down here, and this is where price departs from. Okay, and so what you can do in a situation like that is you can wait for this pattern to occur. You can wait for divergence to occur. Divergence is not just a simple price pattern that you see on a chart and you mechanically trade. If you understand what's actually going on behind, then it makes perfectly sense to embrace the concept of divergence, because it's a very, very interesting concept, and you can see divergence happening everywhere. We can see divergence happened here. You can see that we had divergence happening here, which you can't really see on this time frame, but it's happening everywhere. It happened in so many places here as well. Okay, and it probably happened here as well, which you can't really see a whole lot on this time frame. It happened here, and divergence is exactly what we just talked about. It is price exploring different areas of the market, different price, or rather different areas of value in the market. It's price exploration. It's when price is looking for price points in the market where we have buyers and sellers who are happy buying and selling from each other. Okay, it's looking for value. Price is constantly searching for value. Okay, I mean here we had value, and then we explored the concept of value, and we found, okay, this is actually now value. Then price left, and we found a new area of value. Then price left, we found another area of value here. So price is constantly moving in and out of areas of value. Okay, and so price will, and it'll do this all day long. This is what it does. It's looking for value, and the concept of value will vary depending on what's going on um, um, in the macro scene, or even the micro scene, I suppose, where you have numbers coming out, economic data releases coming out all the time. So if you have a very strong dollar and you have very high unemployment claims and unemployment data, well, this is going to change the concept of value for the American dollar. If we have a strong dollar, but we have signs of the underlying economy being a little bit weak or vulnerable, well, this is going to change people's concept of value relative to the dollar, and it's going to bring the dollar lower to a new perceived fair perception of value for the dollar. Okay, so you're seeing this all the time. And what's happening here, while this is not necessarily economic data releases, because we're not going to have red flag data events coming out all the time. Well, we do, but we're not seeing them come out multiple times each day. They're generally coming out once a week, a couple times a month, something like that. The important ones, at least. And these important ones, these are the ones that are driving the market. Okay. Okay. So what we're doing then is we're looking for these price inefficiencies. We're looking for a price to explore other areas of value. We're looking for price to revisit historical areas of value in anticipation that this will entice new people to get on board. Okay, and so to start off, you could put. Sorry, my wife just came home. Just had to say hello. So I don't remember where we came from, but we're looking for price to move down into these areas of historical value, with anticipation that this will encourage people or attract people to buy again. And when price does not spend a whole lot of time in an area like it did not here, I mean, this becomes an attractive space because we can anticipate the willingness to transact at this historically attractive price in the future. Okay, so price is currently looking to do something, we don't know what. Yes, well, I think I'm going to leave it at that. 17 minutes, that's enough. But if you have any questions, please let me know. And if this doesn't make sense, let me know and I will have another go. Thanks so much for watching, and have a lovely weekend wherever you are.